Today we're going to be looking at the cost classification. So this builds on what we did in our intro to managerial and cost accounting. Basically, today what we're going to cover is or what we want to be able to do is for you to be able to classify costs in relation to things like inventory valuation, decision making and planning and control. So we're going to categorize costs in different ways. So we'd look at product costs versus period costs. We would look at relevant costs versus irrelevant costs, controllable costs versus non-controllable. We would review, because we introduced this last day, cost behavior. So some type of cost. When I talk about cost, these are expenses basically. Could be fixed, right? Like a period cost. They can be variable, like product costs. They vary with levels of production. They can be step fixed, right? Meaning that it's fixed within certain ranges or categories. It can be step variable, right? Or mixed. So let's get into it. So basically, when we use the word cost, we are talking about this monetary measure resources that we are expending in order to attain a product or service, or to create a product or provide a service. So when we talk about cost, that's what we're talking about. It's like a unit of measurement that we're using here in this type of accounting, right? Now, in a business, every product or service has cost of materials attached to it, right? Labor and overheads that is associated with that product or service. And in order for us to be able to, what should I say, forecast, plan, and control, right? We need to take a keen look at costs, right? Because that's also going to determine our profit margins, right? That's why it's so important to managers. So how could you view costs? And this is the thing with managerial accounting. Previously we just kind of view costs in this very simplistic way, right? Where most of our costs was just fixed. You had a fixed rent to pay, you had salaries, and it's like the same amount every month. And but in the real world, cost changes. It's very dynamic. And we could look at cost, so we could define it in different ways. And it's usually based on what our objective is in terms of what we want to report on, right? Or the type of information that we want to provide, right? And this is usually in relationship with different things. These things include the time of incurrence, right? So we have historical costs or budgeted costs. Historical costs would be costs that has already been incurred, whereas budgeted costs, sometimes we could forecast what we anticipate the cost to be in the future. So that will give us an idea in terms of what our possible profit margins is. It also helps us to do a bit more of analysis. So if we budget costs to be at a particular level and then it's above or below, we can make certain decisions based on that. We could say, well, there was a bit of over absorption or under absorption. We talk about that as we delve a bit deeper into this type of accounting. We could also view costs in terms of how it changes with activity, right? And we did mention a bit about that in our first session, in the sense that some costs they don't change, like rent for a warehouse or something may not change in terms of the number of units you produce. Whereas material costs now, that's variable. That would change. If we produce more items, then we're going to use more materials. So a good example might be think about like Coca-Cola, right? Generally, I would like to believe that there's a lot more sales, and I'm talking locally here from my observation, for Coca-Cola soft drink around the Christmas period as opposed to during the year. For some reasons, the culture in Trinidad is one such that Christmas time people is kind of buy a little more extra stuff. And certain things that they won't usually buy or use, like soft drink and extra juices and things like that. They tend to have that because we expect to be a little hospitable around Christmas time, to invite people over and entertain people. So you tend to have more of those things. So all that to say that I could see that if they producing Coke in the factory locally here, they would have more demand for raw materials. Whatever's the raw materials, they're going to use bottles, bottle covers, labels, all of these things would increase, right? So it varies. We could also view cost in terms of its classification on the financial statements, right? Expired or unexpired costs. Some costs, you know, they would we would incur them, and then that's the end of that. And then there's some other costs that, you know, they kind of it's continuous in nature. And then finally we could view costs in terms of decision making. And here, when we're looking at costs for decision making, usually we look at relevant costs versus irrelevant costs. There's some things, regardless of the decision we make, we're still going to incur that cost. You know, example of that might be rent, right? And a relevant cost might be maybe the material to make the product. So we could see costs in each or through each of these ways, right? What you need to remember with it though is that these categories that I've just defined are not mutually exclusive. What I mean by that is that if we categorize something as period, doesn't mean that that particular cost is a period cost and that's the end of that. A cost can be defined in one way at a particular time, depending on what we're viewing it for, right? The type of information we're trying to derive, and on another way at another time, right? Here's an example. Direct labor, that's a product cost, right? But it's also a variable cost, and we could even call that a direct cost. So here, that one cost of direct labor, depending on how we are looking at it or what we are using it for, the information needs, you know, in terms of decision or what, we could view that direct cost through different lenses. In one instance, it's a product cost. In another instance, it's a variable cost. And in another instance, we could categorize it or classify it as a direct cost. At the end of the day, right, they're all correct. It is a product cost, it is a variable cost, and it is a direct cost. It all depends on the lens through which we are looking at it or what we are using it for. Yeah, does that make sense to you? So that's what I mean when I say cost classification is not mutually exclusive. Because I say direct labor is a direct cost, that doesn't mean that's just it. And then at another point in time, is if I tell you it's a product, you know, it's like, well, no, it's not a product cost. You say it's a direct cost. You know, it could be a product as well as a direct cost, as well as a variable cost. Yeah. So now we get into the different types or classifications, so to speak. So we have product cost and period cost, and we did talk about this in our intro last session. Product costs are inventoriable costs. What that means, it's related to inventory. So it includes the cost of your direct materials, your direct labor, and any overheads that involves converting the raw materials into a product, right? So generally, product costs are always related to making or acquiring the product, or in the case of a service industry, providing the services, right? And this directly, as a result, it directly generates revenue for the firm. What that means is that product costs are affected by changes in your level of activity. The more activity you have, the higher product cost is going to be. Period costs, on the other hand, are those that are more related to time and not activity, right? So they are fixed costs. They don't change with levels of output or activity. And we usually treat this as an expense in the period in which they occur. This is why we call them period costs. They're related to time. So when we think about our selling and distributive, marketing, administrative type expenses or costs, right? We usually attribute that to a particular time period, which is usually a year in our financial statements. So you'll find that the product cost is built in, or we'll find that in our schedule for goods manufactured. Whereas a period cost, you would see it in the income statement as a deduction from our gross profit, right? So here's an example of a question from our past paper. Explain product costs and period costs given one example of each. Can you take a few minutes based on what we discussed and just jot a quick answer for me? And then we just discuss it and then look at the other classification. All right, so another grouping or classification we're going to use is relevant, or sometimes called avoidable costs, and irrelevant, or other times called unavoidable costs, right? So those words are used interchangeably. Either they say relevant and irrelevant, or they say avoidable or unavoidable. So this type of cost classification is used predominantly for decision making. So when we talk about a relevant cost, it is a cost whose incurrence really depends on a particular course of action that we decide to undertake. So it means that we have not yet incurred this cost. So because of that, it's relevant to determining the choice that we will make or the decision we'll make in a particular situation or circumstance. So that's why we say it could be avoided. Based on the decision that we take, it could be avoided, right? That's why they refer to it as avoidable cost. So avoidable cost is a relevant cost, or rather, a relevant cost is a cost that could be avoided. And this type of cost classification is used mainly when we're making decisions. You know, example is like a make or buy decision. Sometimes a company might decide, should we make this ourselves or should we buy this from somebody else that's making it? You know, like car manufacturers. BMW now gone make every single thing now going into the BMW. There's certain things that, you know, is their flagship design and stuff and they'll do. But maybe something like the brake system or like a starter or, you know, something as simple as an alternator or something. They might outsource this to another manufacturing company that manufactures car parts, right? So if they did making a decision relating to make and buy, whatever cost involves in things like that, you know, they will be termed or looked at as avoidable costs. They are relevant to the decision-making process. The opposite of avoidable costs is unavoidable costs. These are irrelevant to the decision. It means that regardless of the decision that we make, we're still going to incur this cost. The cost is like a past cost. They already have been incurred, and the firm is committed to incurring them in the future. They also call sunk costs. So that's like your rent. You know, regardless of what decision you make in terms of make or buy or anything like that, still have to pay rent. Whether you make it or you don't make it, you buy it or you make it yourself. You know, there's some costs that are just what we call sunk costs. They're unavoidable, and in that sense, irrelevant to the decision that we're going to make. Yeah, make sense here?
Yeah, sir.
Right. So in making decisions, the concern really should be about how cash would flow. So if cash flows that could be avoided and a particular alternative was not implemented. So should I take this decision if I could avoid this particular cost, right? If we decide not, so it's either a decision of to do or not to do, right? When we're talking about relevant and irrelevant costs, so avoidable and unavoidable costs, it means that if I take this decision or I make this decision, then I'm going to incur this cost. If I don't make this decision, then I'm not incurring this cost. So you want to justify whether it makes sense or not to incur the cost. So here's a little video explaining how we could look at. So when you're doing the make or buy decision, we're only going to be looking at relevant costs, the cost that we would incur if we decide to go the option of making it, right? And you compare that with the cost of, well, you wouldn't incur these. They're avoidable if you decide to buy it outside. So you will use that to sum up the total cost to make it versus the amount of money you spent to buy that particular part outside. And that's what you would use to make a decision, make or buy decisions. Now we want to include opportunity cost in our make or buy decision. So we're going to look at another video that involves a make or buy decision with opportunity cost. Now, what is the opportunity cost though? Is actually the cost or the potential benefit that is given up when you choose a course of action over another. Yesterday I was doing a course of another subject. Sorry, I was doing business with the Form 5s, and we were talking about absolute advantage and comparative advantage, and this opportunity cost came up there as well too. So it's like it's the cost that you would incur or a benefit rather that you will actually lose if you decide to pursue a particular course of action over another, right? So that's important. So if it is we choose to make or buy a particular part, then what are we giving up? If we decide to make it, right, it now means that we're going to be having to allocate time and resources towards making it. So what are we losing rather, or what is given up, foregone, right? Because you choose this course of action as your opportunity course. All right, so let's take a look at the video with our example so we can get some better insight in how this applies to make or buy decision. Yeah. All right, so the other cost classification we're going to look at is controllable and non-controllable costs. So we just got through relevant and irrelevant, otherwise known as avoidable and unavoidable. Now we're going to talk about controllable and non-controllable costs. So there's some costs that are under the control of management and others that is not really within their control. And when we talk about controllable costs, we're talking about those that could be changed based on your actions. Non-controllable costs, you can't change them. You're going to incur them regardless. So an example, a company rents a warehouse at a cost of $1,000 per month. This is not controllable by the manager. You would have signed a contract and you are obligated to pay $1,000 per month if you're renting the warehouse. The same company is interested in purchasing our premises for additional production. The amount of money they will spend on the premises is within their control, right? They could determine whether, all right, we want to buy premises, our budget to buy premises is 1.5 million, right? We're not spending more than 1.5 million, right? That's within their control. They could set the price that they will be willing to expend on the purchasing of our premises. But what they can't change is the cost of the rent for the warehouse. That's non-controllable. Make sense? So a company can control the amount of expenses such as electricity, telephone, and traveling, but not rent, right? Because these things are all based on consumption. There's a rate, and depending on your usage, you will pay a fee, right? But rent is a negotiated something. You sign a contract to lease a place for a period of time at X amount of dollars per month, per quarter, per year, right? That's not controllable. All right, so we're gonna get in, or we're gonna look at another video on cost behavior, right? This is gonna touch on something that we did last week,